Okay, guys, so let's have a look at the oil price, the US dollar, and let's have a look at the Canadian dollar and the Norwegian krona against the US dollar in the market. So let's look at oil. So we saw oil really sell off aggressively when the pandemic first gripped the global economy back in March. That's because demand for oil dramatically was reduced when borders were shut. The aviation industry went into sharp decline, and petrol was vastly reduced in its daily consumption around the world. So the demand for oil dropped, and then you had the price dramatically fall around 80% from the highs of last year. And then on top of that, Russia and Saudi Arabia got into a price war in terms of increasing the supply whilst the demand was dramatically reduced. So oil declined dramatically during that period of time. Now, remember, if you're looking at countries like Canada, their main export is oil. So if you're looking at their key exports, 15% is crude petroleum. Then you have refined petroleum around 3%. So it does make up around 20% um, altogether. Sorry, and then you have petroleum gas as well, which altogether makes up around 20% of Canada's export. So clearly, oil is a very key export for Canada. When you look at Norway, oil's an even bigger export, making up around 50% when you look at everything that is produced and sold from Norway. So clearly, when the oil price had a sharp decline, you then automatically saw, for an example, the Canadian dollar weaken dramatically during that same period of time against the US dollar. So in the beginning of the year, oil dropped, and then the US dollar got very strong against the Canadian dollar, just as oil prices were dropping. And then as oil prices started to rise again around April times, that's when you saw, again, around April, May, the Canadian dollar start to strengthen back against the US dollar. Then we had on top of that, guys, remember, the Federal Reserve slashing interest rates in the United States aggressively towards zero, and the US dollar lost its attractiveness as a high yielding currency. High yield basically means a currency that pays a higher interest rate relative to another currency. Because remember, when you're trading a currency pair, you're paying out interest on the currency you're borrowing, and you're getting paid interest on the currency you're buying. So if I buy the US dollar against the Canadian dollar, remember, I have to first own the Canadian dollar. I sell my Canadian dollars in exchange to buy US dollars. So I'm borrowing the Canadian dollar to finance the purchase of the US dollar, and I'm paying interest on the lending rate in Canada, and I'm receiving interest on the deposit rate in the United States. And obviously, the difference between the two will mean you're either paying out more money or receiving more money, depending on which way you trade the currency pair. So altogether, the US dollar lost its appeal as a currency that paid a higher interest rate than other currencies, and we had oil prices rising. So what this basically meant is that more money is coming into Canada as oil prices are rising to pay for those higher export costs. Exports for oil, and that reduces the Canadian dollar's rest of world currency reserves, whilst at the same time we know the US is always increasing their rest of world US dollar reserves because they're running a deficit in their current account balance. They're basically importing more than exporting, so more dollars are going into the rest of the world than are coming into the United States. And then when you compare the two rest of world reserves of both countries' currencies as a ratio, that's how you get the exchange rate. So more dollars are going to the rest of the world in the US. Fiscal stimulus coming from Joe Biden, around 1.9 trillion he put forward yesterday. Then you have higher oil prices, and oil could go back to around $70 a barrel where it was trading last year, and that sets a stage for more downside selling in the US dollar CAD. We are sitting now at a major support level, and if you go into the chart, you can see, if you take it to a monthly chart and get a bird's eye view, this is a support level that has been holding markets going back to 2009. You can see a lot of price action around this exchange rate value, and that's why we've stopped around here before, and we're coming up and we're stopping around here again. Once we get below this level, then that could signify the trend is still in play, and we can short those currency pairs at the downside. As long as oil prices keep rising, as long as more fiscal stimulus comes into the US, a lot of those dollars are going to go into the rest of the world, increasing the US dollar's rest of world reserves and decreasing its value in the exchange rate. Now, obviously, OPEC, led by Saudi Arabia and Russia, are cutting production of oil on purpose to manipulate the supply and demand equation to help lift oil prices. If they can continue to do that and demand increases as the vaccine rollout is implemented, then that will be positive for oil prices and probably put further strength in the commodity to the upside. So we could either sell USD CAD, or we could even buy the oil price, or we can sell US dollar Norwegian krone, as we just looked at. Norway's main export is oil, and you've seen the same correlation between the oil price and the Norwegian krone getting stronger against the US dollar. So you can see the same situation playing out when you look at this situation as well. As soon as oil prices started to rise, the Norwegian krone again started to strengthen back against the US dollar. So again, we can either take more short sell positions for this currency pair, or we can sell the oil price. So there's quite a few things we can do, but just to understand, I put some alarms here just to see if we break the lows that was previously formed, and we're going to take another short position to the downside for this currency pair, or we can buy the oil price, or you can buy Canadian dollar, Japanese yen, which has been rising, as we can clearly see here, as the oil price is getting higher. If you get above this key resistance level of 82, then this, and as you can see, we've been selling off at this level. Each time we've come up here, we've been selling. If we can get above this clearly, I'll set an alarm here. We could jump into a buy, or we could buy the Norwegian krone as well, which again has been rising. We're now back at this level here, which was a previous resistance. If we get above this level, we can look to buy. Now, why would we match up these two currencies against the yen as well? Because again, Japan's interest rate is very low, which basically means it doesn't cost you anything to borrow the Japanese yen to buy another currency. So you're not losing money overnight when you take this trade. And obviously, higher oil prices should decrease rest of world reserves for Norway and Canada. And that should, in theory, push the currency pair higher in the exchange rate. So one thing to note when we're looking at economic data as well is that manufacturing PMI in the US is a leading economic indicator for oil in itself. So look, when manufacturing PMI data in the US is below the level of 50 and contracting, we know that means that GDP growth in the US is set to contract. And if the US economy is contracting, then the rest of the world economy gets into trouble and the demand for oil falls. That's why when you see the manufacturing PMI data going lower, you see the oil price following the manufacturing. And then as soon as the manufacturing data starts to push back to the upside, indicating growth in the US is going to be returning, oil prices quickly follow this expectation, because if the US starts to grow, so does the rest of the world economy start to grow, and then oil demand will increase. And that's why when you look at the two, they move in very tight correlation. As soon as you see the ISM starting to sell off, the oil price starts to sell off. As soon as the ISM starts to rise again, expecting growth in the US, the oil price follows quickly the expectation of growth in the US. Because just remember, the US is the world's leading economy. It is the biggest economy in the world. So if the US is growing, automatically, so is the rest of the world economy. So at the moment, US growth is looking positive in the next 12 months. We've got growth at the moment at around 60. Sorry, you've got manufacturing at 60.7. That's very good. And that should indicate that the demand for oil will be increasing as the US economy grows. And that's why oil is now bullish at the moment. So that should back up our view for higher oil prices. As long as the US is expected to grow, then the demand for oil should grow. Even though oil is coming towards the end of its history, because now we're now moving to a green energy, there is still upside potential for oil prices at this moment in time. So that's why manufacturing is so important to the oil price, because manufacturing, as we know, predicts GDP growth in the US with an 85% certainty going back to 1948. So it's an important indicator we have to follow very closely. So that's our bias. That's our trade ideas. That's looking at oil, US dollar, and the commodity currencies. Thank you.